Early-stage venture capital is entering one of its most uncertain eras. Historically, acqui-hires offered a kind of safety net. When startups ran out of money or couldn't scale, big tech would sometimes scoop up the team. Investors didn't celebrate those deals, but at least they got a check, and the founders landed on their feet. But now, something more disruptive has arrived: the reverse acqui-hire. Instead of acquisitions, companies like Microsoft or Google simply hire away startup founders and engineers directly. The startup itself is left behind, investors see nothing, and equity becomes worthless. This shift is rewriting the risk profile of early-stage investing. In this session, we'll look at where acqui-hires came from, how the definition of reverse acqui-hire has changed over time, and why venture capital may need entirely new structures to survive in this environment. The acqui-hire has been part of startup vocabulary for over a decade. The word is a mashup of acquisition and hire, and it refers to a deal where a large company buys a smaller one, not because they want its product, but because they want its people. The product itself is often shut down almost immediately. Facebook did this with Drop.io back in 2010. Google picked up Kaggle in 2017, not so much for its competition platform, but for the community of data scientists and the talent behind it. Stripe used acqui-hires to quietly build a deep bench of fintech engineers long before it started doing larger acquisitions. For investors, acqui-hires were never particularly exciting. They rarely delivered venture-scale returns, but they were better than a total loss. You might get your capital back, maybe a small gain. For founders and employees, they were usually a relief. A failed product could turn into a stable job, stock in a tech giant, and a path forward. In short, acqui-hires were a middle outcome in the venture model. Not great, not terrible. When the phrase reverse acqui-hire first started floating around in Silicon Valley, it meant almost the opposite of what it means today. Back then, the idea was that startups were the ones doing the raiding. Instead of big tech absorbing small teams were poaching senior talent from big tech. Think of Snapchat in its early days, convincing engineers to leave Facebook to help it scale, or Slack around 2015, when it recruited experienced staff from Amazon and Google. More recently, we've seen Mistral, the French AI startup, lure researchers away from DeepMind and Meta to quickly build credibility. For startups, pulling in talent from big tech was a sign you were legit. If people were willing to leave Google or Meta to join your small, risky company, that meant you were onto something. For investors, this was a reason to celebrate. If your seed-stage startup could convince top-tier engineers to jump ship, it de-risked the investment and made the company look like a potential winner. Today, though, reverse acqui-hire means something far scarier for venture capital. The definition has flipped. Now it describes the process where big tech raids a startup by hiring away its best people, but without ever acquiring the company. Microsoft, Google, or Anthropic simply make offers the startup can't match. Founders and engineers switch badges, and the company they leave behind is hollowed out overnight. There's no acquisition process, no liquidity event, no payout to investors. The startup itself remains, but without its core talent, it's essentially a shell. For hyperscalers, it's efficient. Why spend hundreds of millions acquiring a company when you can just hire the brains? For founders, the pull is strong. Suddenly they have unlimited compute, vast resources, and compensation packages startups can't hope to match. But for seed and Series A investors, this is devastating. Equity that looked promising one week can become worthless the next. We've already seen multiple examples of this new reverse acqui-hire play out. In 2025, Microsoft hired the co-founders and senior engineers of Hyper, a London-based AI video startup that had raised close to 14 million euros. By February, the consumer app was shut down, and by June, the remaining assets were sold off to Netmind. Investors got nothing. That same year, Anthropic absorbed Human Loop's co-founders and team. Again, no acquisition deal. In 2024, Microsoft brought in Mustafa Suleyman and much of the team from Inflection AI. These weren't acquisitions in the traditional sense. They were team transfers. The intellectual capital moved to big tech, while the legal entities in the cap tables stayed behind, stranded. For investors, this is the nightmare scenario. Unlike a traditional acqui-hire where at least there's a modest payout, here the company is simply gutted and the shares you own become worthless paper. This trend is so damaging because startups are fundamentally about people. You can talk all day about valuations, markets, and growth, but at the early stage, most startups are really just a small group of brilliant humans and the intellectual property in their heads. When those people walk out the door, there's nothing left. Hyperscalers know this. They can offer compensation packages and unlimited compute resources that no seed stage company can compete with. For technical founders, the choice can feel obvious. Join Microsoft or Google, and suddenly you're working at planetary scale with unlimited GPUs and infrastructure. Why spend another year struggling to raise a Series A? But for investors, this wipes out value instantly. There's no failed product to analyze, no competitive loss to explain. It's just an equity stake gone to zero overnight. That's why reverse acqui-hires are being called the silent killer of early-stage VC. For seed and Series A investors, this shift forces a hard rethink. The old model assumed 4 possible outcomes for any deal: IPO, acquisition, acqui-hire, or a total failure. Now there's a 5th, the reverse acqui-hire wipeout. And unlike failure, this one often comes after the company has traction, a product, or even paying customers. But if big tech decides to pull the people, the company disappears. Capital evaporates with no liquidity. For investors, this means deal structures must change. Term sheets need stronger key person protections. More attention needs to go toward team depth. If 80% of a company's value is concentrated in 2 founders, that's a massive risk. Talent concentration must be front and center in due diligence. And exit modeling has to include these outcomes. Pretending they don't exist is like ignoring down rounds in portfolio math. So where do we go from here? The first step is to accept that reverse acqui-hire risk is the new normal, especially in technical fields like AI, robotics, and biotech, where talent is scarce. Investors need new tools to manage this risk. One idea is the VC risk swap, essentially an insurance-like structure that guarantees at least a break-even outcome if your company is gutted by talent poaching. Instead of going to zero, you lock in the kind of middle outcome that old-school acqui-hires used to provide. Beyond structures, venture capital need to push startups into enterprise adoption earlier, because enterprise contracts create stability that makes teams harder to dismantle. And most importantly, playbooks must adapt. Build resilient organizations, not just brilliant teams. Assume hyperscaler pull is inevitable and structure accordingly. Because if venture capital doesn't adapt, early-stage investing really could end up on life support. Check out the VC risk swap for an alternative option.